Well, I think we are clearly in a bubble. I don't think there's any. So I started my career in 1999, and I was an econ major from one college. So I remember, once you're an econ major, you study what is a bubble, and there are classic signs. There's uh, greater fool theory and animal spirits taking over the markets and people investing because there's someone who's going to buy it for more versus the value that they see in it. And I hate to say something controversial, but I think, is it called NFTs or NFX? I forgot what the term is for these
NFTs. Yeah.
NFTs. It's outside of my domain, so you'll excuse my ignorance. But these basically JPEG files, whatever that people are paying crazy amount of money for. That's like buying Beanie Babies back in the 80s or tulips in the Dutch bubble centuries ago. It just doesn't make sense. Unless that person is a wonderful artist and is something you're going to hang on your wall or maybe trade with your friends. I think at the end of the day, if you're buying something because you think someone will just buy it from you at a greater price out of their ignorance or their animal spirits, then that's kind of speculative. And you're seeing that now in biology. You're seeing it and by the way, it's easy to detect. If you see a company that's valued at $3 or $4 billion and they don't have a working product and they're claiming to do something which they haven't demonstrated they can do, and they have zero revenues, that's probably not a great investment. They could become the next Illumina. More likely they won't. And if you add up the market cap of all these hyped companies, it's probably greater than the actual market size they're addressing. And so when you see that, you recognize that we're in a bubble. And there are clear reasons why we're in a bubble in certain sectors. I don't want to say it's in all sectors, but in certain sectors. The reasons are there's nowhere else for capital to go. Interest rates are at zero. Essentially, in some countries in Europe, elsewhere, they're in negative territory when you take into account inflation. And so, rich people have nowhere to put their money, and institutional funds have nowhere to put their money. They have to pile it in, and there's a lot of hype around cool technologies, and so it drives up the price. We have to be very careful as investors that we don't partake in that, because it's all cool in the moment to get into a deal when there's FOMO and the valuation goes from 10 million on Thursday to 20 million on Tuesday of the next week because Y Combinator taught that company to do precision pricing of their safes. But as an investor, you're going to look really bad when the music stops and you have to sit on a chair and there's nowhere to sit because that was just a stupid decision. And so we try to be very disciplined about that. Our check sizes will reflect what we think is the nature of the company, its chances of success, and the valuation. At the end of the day, valuation is very important. And I think some entrepreneurs, I do have to say, may be making a mistake in optimizing only for valuation at the expense of the type of capital they're taking in. The most important determinant of success for an entrepreneur when it comes to their board and their investor base is who is that investor. It's not the most important determinant of success, period, but in terms of their selection of investors, who that person is, what that person has done before, what value they can add should be the central question.